Hello, my name is Jingonelli, and today we are going to be joining an accounting class. But before we join the class, make sure you subscribe to the channel.
Okay, people are losing data. Now, well, my name is Mohammed Ssebaale, and I'll be taking you through audit planning and risk assessment. I believe by now you greatly appreciate the concept of auditing, which is basically a practice of independent review and examination of books of accounts and financial statements with the goal of forming an opinion, of basically giving a reasonable assurance on the state of affairs of any business. Auditing stems from what we call the stewardship relationship, where we have an owner and a manager, where the owner provides resources to the manager to run the business. And at the end of the day, the manager is supposed to account or to give what we call accountability. However, as managers, we have our own interests, which may be contrary to the interests of the owners of the business. So because of that conflict of interest, it necessitates to bring in an independent person who is external to the entity. And that person is called an external auditor. That external auditor is purely going to review and examine work done by the manager to ascertain or add credibility to the financial reports that have been supplied by the manager to the owners of the business. And that process is what we call auditing. Like any other practice or like any other very crucial activity that is being done, planning is very crucial. Planning gives you the way forward. It helps you in ascertaining the resources you need. And for the sake of auditing, it helps you know where you're going to concentrate and what you are supposed to do. And basically, auditing, we have a lot of risk exposures in any business that we encounter. So it's very imperative that as you are planning to conduct an audit, you do a risk assessment. You're looking at the exposures of the business activities that may in the end also affect your work as an auditor. So in a nutshell, that is why we're going to study audit planning. So audit as itself is made up of 3 phases. Audit is made up of 3 phases. We separate them into 3 in a way that we have the planning stage. That planning stage includes the accepting of the engagement and planning and risk assessment. Then we have the performing stage or phase that looks at the tests of contract substantive procedures. Then we have the reporting phase that now comes up with the report, or what you call an audit report. So basically, those are the phases, but audit is divided into 4 main parts. The first part is the accepting of an engagement. An engagement is like that assignment where a client, we call them audit clients, approach an audit firm, and then they say, we have appointed you to do the assurance services for us. That is the review. So as an auditor, you have to carry out what we call preliminary engagement activities before you accept any new client, or you renew, we call it renewing, or you renew your relationship with with the same client that you had in the previous year. Because normally the engagements are for 1 year or 1 accounting period that can be renewed based on the regulatory framework of that business. There are some businesses where, especially in financial institutions, that is banks and insurance companies, where you cannot have an auditor, the same audit firm, for a period of 4 years. The maximum is 4 years, so you keep on rotating every after 4 years. But before you take on any engagement, you must first do those activities, those preliminary activities. What is involved? You have to ascertain whether you have the capacity to undertake that engagement. Capacity in terms of skills, in terms of manpower, in terms of understanding the regulatory framework this entity is following, capacity in terms of meeting the reporting deadlines. So you don't just accept because you are in need of a job or in need of a consultancy. You have to ensure that you have the ability and the capacity to perform that engagement. You must have studied in the previous topic what we call professional due care as a code of ethics of an accountant, and professional professional development, where you have to, what you keep in mind is your ability to diligently fulfill an engagement. You don't look at money from a professional point of view, look at your ability to take on an assignment. So if you find out that you don't have the capacity, then you're better off declining. So this takes some time because you have to understand the client that you're dealing with, what kind of industry are they in. For example, you may be dealing with a company like Total Energies, and you don't have anyone within your team who has the capacity to audit petroleum products. Or you don't even have the ability to get an expert, because sometimes you may need to get an expert, someone who is well versed with a particular line of business that you're auditing. So that access is a very important aspect of audit. Then after you've accepted the engagement, you've done all that is required, then you plan the audit with the objective of coming up with an overall audit strategy. So here you're basically looking at what is the timing, how many weeks are you going to take, how many people do you need, because now you've ascertained that you have the capacity. Do you need the help of an expert? Then you also do a risk assessment, looking at what are the most risky areas in the audit that you're going to pay attention to. Different companies, different sectors have different risk exposures. You may find that for maybe a telecom industry, the line of revenue is very crucial because of the extent to which they keep on recognizing revenue. Every time you buy airtime, every time you go for bearer call, you borrow, revenue is being recognized. There's a very high risk that revenue can be double recognized. Then when you go to the insurance industry, you know that the risk is understatement of insurance liabilities. When you go to a heavy cash business, you know that now there's a risk of fraud, or a risk of stealing cash. So when you ascertain the risk that the business is exposed to, then you set up your audit strategy depicting those risks. Because as you know that risk cannot, as you know that audit, we don't do 100% audit. You can't do 100% audit sampling, right? So when you sample, there's a very high possibility that you may leave out some crucial areas unattended to. But then when you start with risk assessment, you place a lot of focus on those risk areas, those areas that are vulnerable to material misstatements. Yeah. So those are the areas that you concentrate on. You develop a plan, you're going to, who is going to do what? Because sometimes even when you look at your resources, an audit firm is made up of audit assistants, audit seniors, audit managers, engagement partners. But even within your team, for example, with due respect, you might have someone who has just graduated with a BBA, but then you won't take that person to audit, let me say, insurance contract liabilities in an insurance company, or to audit cash in a bank. It flows with the level of seniority and the risk exposure. So unless you do that risk assessment to determine your audit plan, then you won't get things right. So those first two parts are what we call the planning phase of auditing. Then after you've done that planning and your assessment, then you perform the audit. Now this is field work. It's the second phase of audit. It's called the field works phase. Here you perform the audit by applying the tests of controls and substantive procedures with the aim of obtaining sufficient and appropriate audit evidence. Now, here, if you are not in a position to obtain sufficient and appropriate audit evidence, then you cannot form an opinion. Or if you form an opinion, you'll form an inappropriate audit opinion. You will end up qualifying statements, yet you ought to have you will end up issuing a qualified report, yet you ought to have issued an unqualified report. For your purposes, maybe to emphasize, a qualified report is a bad report, whereas an unqualified report is a good report. So performing the audit is now when you do the vouching, you go through the internal controls. Internal controls are those mechanisms that try to minimize error and fraud to test whether they are actually working well. I'll give you an example of internal controls. There's what we call segregation of duties, where you find that, hello, do you have any questions? Okay.
Your network poor.
My network is poor. You can't hear me.
It is breaking.
Is that the same for everyone?
No, sir.
Can I have you?
You're
Huh?
actually
No,
very
it's
clear.
not.
It's okay.
It's okay. Yeah, then I think
The network is poor.
I think that person's network is probably having issues. Okay, so I was talking about when you're performing audit, we do what we call tests of controls. You test the internal controls to see whether they are effective enough to prevent, detect, and correct any material misstatement. Let me give you an example of bank reconciliation. Bank reconciliation is an internal control in respect to bank or cash at bank. Yeah. So now its effectiveness will be how often is a bank reconciliation done. It is recommended that a bank reconciliation should be done on a monthly basis, 15 days after the previous month. Because when you do that, it means that any misstatements, any errors can be corrected in the following month. So there are some people who have controls, but these controls are not working. They're just on paper, but they are not working. They are not designed to actually detect or prevent material misstatement. Another issue will be segregation of duties as a control. Segregation of duties where you have different people doing certain particular tasks in an accounting process. For example, the person who receives cash shouldn't be the same person who is going to make payments, shouldn't be the same person who is going to do banking, should not be the same person to perform bank reconciliations. Once you find that, that means the controls are weak. The moment the controls are weak, that points to high risks. Okay, so the tests of controls are the preliminary activity that you perform while doing an audit. Then there are what we call substantive procedures. These are designed to detect material misstatements in financial statements. Now, these ones include things like analytical procedures where you're going to do ratio analysis, or you're going to do deep tests of particular classes of transactions, account balances, and disclosures. For example, where you are going to perform a recomputation, or you're going to do a recalculation of your depreciation, or where you're going to attend a stock take, where you're going to do third-party confirmations, as in checking with the external people to the entity. Those are what we call substantive procedures. Substantive procedures are more detailed than the tests of control. Tests of controls are normally done watching. You are testing whether the controls are working okay. But then if you want to obtain more detailed audit evidence, then you perform what we call substantive procedures. Yeah, so that is, it's a process. It takes more time compared to others. Whereas audit planning is done continuously. Yeah, this is now where this performing of the audit is the field work. Okay, now after you've performed your audit, you've gathered your audit evidence, now you have to review this audit evidence. You have to review to confirm whether it relates to maybe expectations, whether it is sufficient enough. Because at times you find that the evidence you've gathered is not sufficient or not appropriate. Then you have to perform another substantive procedure. So after you've gotten your evidence, reviewed it, you complete the audit, and then you prepare an audit report. So here you're checking that the financial statements are consistent with the auditor's knowledge of the entity. For example, if as you're auditing the bank, we know that there's application of IFRS 9, yeah? You know the exposure that you expect in respect to a bank. You've done some reading, and you have a particular understanding about the bank that you're auditing. So when you find that the reports, that the financial statements are giving something different from what you know, then something is probably not right. Then there are instances where you also have to obtain what you call management representation. For example, you need management to confirm in writing what they believe is really happening in the company or in the business. After you've done all that, then you form an opinion and you issue an audit report. So in a nutshell, that is what we call an audit process. So I'll pause for now, then I'll entertain some questions in respect to the audit process. So ladies and gentlemen, kindly throw your questions. Or should I assume that everything is okay? Let me start with Nelly. Nelly, as the coordinator, do you have any questions?
I don't know if your network is all right because I've not been hearing you.
You've not been hearing? Okay, Mary Blessed, not your name, Mary, since you are unmuted. Do you want to ask a question? Yes, MM, please ask your question. And I request that we be civilized. To Shave Anthony and Nachayune Mary, please mute your mics. Yeah. MM, can you ask your question?
Yes, there is where you mentioned that we don't always give an absolute opinion or assurance. Yeah. However, my wonder is, we always have to rely on limited assurance, because since we cannot give an absolute one, so when do we give an absolute one?
Yeah, maybe not to say limited. The other, we have what we call absolute assurance, that one you say 100%. Yeah. Yes, but what we give is called reasonable assurance. The reason is, just imagine how many transactions would you expect MTN to have in a year, MM? There will be millions and millions and millions of transactions, isn't it? And that is over a period of 365 days. But when you do an audit, you can do an audit for like 7 weeks. Yeah, that is like 1.5 months. So in 1.5 months, you cannot really cover everything that has been done in a year. You get, and so what you do, you sample. But when we are sampling, there are mechanisms that there are softwares that are used that will pick a representative sample from the population of the transactions. Yeah, so that is why, and in audit we say the financial statements, that is if an opinion is being raised, show a true and fair view. True and fair view. You can never say correct, right? Because you have not looked at everything. Because you might choose to look at something, but then what you leave, which may even be immaterial to the accounts, but when aggregated, there are quite a number of them. When aggregated, they may become so material. You get. So there is that element. You cannot say that you're absolutely sure that the financial statements are free from material misstatements, because you're not looking at everything. I don't know whether I've answered your question, MM.
Yes, sir.
Okay. Yeah. Any other question? Guys, is the process okay?
Yeah, sir, I beg you pardon.
Yes, sir.
Yes.
On
Okay.
substantive procedures.
Exactly.
Andrew, you're saying?
Yes.
What do you want? You're saying point 3.
On point 3, substantive.
Yes.
Point
Substantial comes from.
I beg your pardon.
Yes. Okay. Like I said, when you're performing an audit, you basically using 3 approach. You're using those 2 approach. You test the controls, as in you test the internal controls of the business, whether they are really sufficient to prevent, detect, and correct any material misstatements. Now, when we talk of testing, testing is like you're not doing really a lot. You're not doing a lot. You're just checking, okay, do they perform a bank reconciliation? When do they perform it? Who does it? Is it reviewed? You know, that you're testing, that is now testing a control of bank reconciliation. But it will show you that yes, bank reconciliations are done, but you may not be in a position to detect a material misstatement. So material misstatement can only be detected when you now do more work, that the substantive procedures. You now, like one example of a substantive procedure is you reperform the bank reconciliation, you redo it. Yeah, you redo it, because when you redo it yourself, you are more likely to find out that these guys are actually cooking the bank reconciliation. Another example I can give you, under test of controls, is what we call stock taking. Stock taking, as in someone, let's say a supermarket like Capital Shoppers, do they count their stock? Do they like regularly, or let's say after a month or 3 months, do they count their stock to ascertain the stock they hold at a particular point in time and its condition? If they do, then you've tested the control, you've ascertained that it is there. But it may not save you good evidence, not until you probably attend a stock take. Now that is a substantive procedure. Substantive procedure goes deep, it is more detailed compared to a test of control. Have I answered your question? Was it Andrew?
Yes, sir, very clear. Thank you.
Okay. There's someone who had another question? Amon Dega. Do you have any question? Is everything okay? Amon, Koleb, Raf. George William Luswata. George William Luswata, is everything okay? Well, I guess everything is okay then. I won't struggle with you. Okay.
Yes, I'm okay.
Okay. Yeah. Now, let us look at the first phase, which is audit planning, what we said. So audit planning is basically, like I mentioned, arranging your audit work, how you're going to do it. Now, the planning varies based on the complexity of the assignment. You might find that the same planning you need to audit MOOBs as an institution of learning is not the same planning you need when you're going to audit a bank, when you're going to audit an insurance company, when you're going to audit a hospital, when you're going to audit maybe a pharmaceutical company. The more complex the business, then the more audit planning you'll have to do. Now, what does it entail? You have to come up with a strategy that you're going to employ in well auditing. And like I mentioned, again, it depends on the nature of the business. The direction you're going to audit. Are you going to do an interim audit, or it's not necessary? You know, interim audit is that audit that you do like around September. It is like the first audit you do to set the ground rolling. Then you also have a final audit. In some instances, you may not need to do an interim audit. Some instances you will have to do, but practice is that nowadays, all majority of the audit firms do interim and final audit. Then the scope, what are you going to cover? You know, how far are you going to go? You know, then now this also depends on your materiality. Yeah. If for example, you have an entity like Capital Shoppers, you know, and Capital Shoppers has like, let's say 4 branches. Are you going to attend a stock take in all 4 branches? Or if you do 2, it may be representative of all the 4. You know, that is the scope and how you're going to conduct your audit. Are you going to bring in an expert? Do you need an expert? Do you need to subcontract another audit firm to do a particular task for you? You know, so when you do all those, then you form what you call an audit program. Like, what am I going to audit first? How long is it going to take? Who is going to do it? What procedures are we going to employ? Are we going to stop at only the tests of control because we have ascertained the risk is not high, and even then, because the controls are working effectively? Yeah. So when you do a plan, it gives you a more formulated and organized way of doing an audit. Like the way you plan your exam period, and you say, I'm going to read from this topic to this topic, then I rest, then I'm going to touch accounting, then maybe because I'm doing accounting as a first paper, I'm going to read it maybe towards the paper. Okay, the way it makes whatever you do organized, and once you have it, then you're going to use sufficient time, you're going to meet your deadlines, you're going to gather sufficient audit evidence. Okay, so the benefits are really, it helps you place a lot of emphasis on important areas of the audit. Like I said, because audit, you can't do everything, so you have to plan so that you place your attention on the more risky areas. Yeah. Then it helps the audit also resolve problems on a timely manner, because your program is properly set. Yeah. It helps you organize, you know, it helps you know who is supposed to do what. Selection of the engagement team. Like I said, people have different competences, skills, and capabilities. You won't get a complex area of a financial statement and you give it to a junior auditor. Are we together? So it helps you know who is going to do what. Because you won't carry all your audit. You won't carry, for example, an audit team may be made up of 7 people. An audit team may be made up of 7 people, but not all those 7 will go to the field at the same time. So it helps you know how the work is going to be done. It helps you as an audit supervisor to review the work done by your people. Yeah, it helps you coordinate the work effectively. Like I said, where you may need experts, where you may need to subcontract, all that is going to be possible only if you do your plan well. Okay. So what do you need in an audit plan? You'll have to put your risk assessment procedures, what you've done. You'll have to look at the materiality levels. Materiality levels are those levels where you send out, this one we want to look at, this one we shall look at. Then what you have from your risk assessment, what have you identified as the more risk areas, and what are you going to do about it? What is your planned response? What approach you're going to take? The staffing you need, their qualifications. Then there's also an element of independency. An element of independence is the person. You have to confirm that all the people you have on your audit team are independent of the staff of the audit client. For example, I'll give you this example. This is a practical example that I encountered. One of my audit, my students happened to be part of the audit team that had come to audit at our workplace. And at that time, being a CFO, of course, you have to meet the audit team, they approach and they introduce you. Now, to this person, it appeared that the person would not be very comfortable auditing and work that has been done by the person who taught them auditing. So that created what we call familiarity threat, yeah, because the person was used to me, probably didn't see it fit that they would do a good job being on that audit team. So in that way, the person had to be changed because they were not going to be probably objective. You might find instances where, for example, you cannot be part of the audit team that is going to audit a company where your girlfriend works as an accountant, yeah, because then there won't be independence at all. So that audit staffing is very crucial as a content of the audit plan. The timetable, it is very, very bad for an auditor not to meet the reporting deadline. It is very, very bad. Actually, if it so happens that you fail to meet, because some entities are highly regulated, for example, the banks and insurance companies have to submit their financial reports, their audited financial reports to their regulators by 31st of March every year. So, but before that audit report is submitted, it has to be presented by the auditor in the board of directors meeting, which normally happens between 1st of March to 15th. So anything that is done, reported to the board, discussed, finalized, then the audit report is set up, the financial statements, the report is well prepared, reviews are done. By 25th or 20th, the report should be ready and the management should be in a position to report. It is not always good to report on the deadline. So the timetable is very crucial. The costing, once you get your costing right, then you're going to do a good job. It's not also right for an audit firm to find themselves in a way that they have budget constraints, as in they underpriced the assignment and they cannot perform particular tasks. For example, they cannot go to attend a stock take in Gulu because they underpriced the assignment. See, it looks at the nature of the procedures you're going to look at, what items are you going to look at, when are you going to perform your procedures. Sometimes you have to fit into the timetable, you have to fit into the time of the client that you are auditing. So basically, the whole plan should rotate around you being in a position to perform your job diligently with the objective of obtaining sufficient and appropriate audit evidence. Okay? Now, any questions up to that extent, ladies and gentlemen? Is everything clear about the content? Isaac Akampurira.
Excuse me, sir.
Yes, sir.
I'm inquiring about who determines what should be the content of the audit, the client or the audit firm?
Yeah, now the audit firm determines the content of the audit plan because you have studied the client, you've understood what they do, you've done your risk assessment, and you have ascertained what is going to be, how you're going to approach your audit. Now, of course you discuss with the client, and because you need their buy-in. You need their buy-in, especially when it comes to the timelines, because you're going to tell them this is when I'll need this information, this is how I'm going to escalate. Because when we are being audited, for example, you don't go straight to the chief finance officer because the chief finance officer has a team, So you agree that this is when we intend to share the schedule of what the schedule of what we need. Then we expect to receive the documents at this time. If we don't, maybe this is when we shall escalate. So you need the buy-in of the client. So the plan is set up by the audit firm or the audit team, and then they coordinate with the audit client, so that there's that relationship, not a relationship of friends, but a working and professional relationship, because sometimes the client can frustrate the work of an auditor. Are we together? Then that makes everything hard. I don't know whether I've answered your question, sir.
Thank you, sir. You have answered it partly. Now, for instance, on the timetable, me as a client, I could be having suspicion that there is something going wrong in my company.
Yes.
That means I will set deadline of the audit because I want a certain, how certain transactions have been carried out.
Yeah.
That means I will set a timeline and say by the end of 30 days, 30 calendar days, at least give me a report of what has been transpiring in my company. That means the audit firm has to work alongside that deadline.
Yeah.
That will also include even the funds. The funds, I may even set, timelines or even payment targets, because for me, I see the client having a big hand in setting the audit plan.
Let me first answer him. Yes, you're right. The client has a big hand, but like you mentioned, that for you say I want it in a month, right? That may not be right, because if I can't give it in a month, if we look at what we are supposed to do, I'll take you through what I am supposed to do. I've done a risk assessment. I have ascertained that, there is a lot of exposure. And for me to get to the bottom of this exposure, I need so much time. You get it? In most cases, where people are dealing with small audit firms, you might push them to that extent. And then they will say, okay, we shall give you a report in 30 days. But the issue is, it may not be sufficient, because you've limited their time and they're not in a position to get sufficient evidence. However, the more time they take, the more money you're going to pay as well, right? But like I said, it should be a consensus between the two. You need to understand where the audit firm is coming from, and also the audit firm has to appreciate where the client is coming from. Like I mentioned, that, for example, us in the insurance industry, we have timelines when it comes to reporting. So that means that the audit should start early enough. You get what I'm saying? Instead of you limiting the auditors in their time, you start early enough so that you beat your budget, you beat your deadline. And also, cooperate as a client. When they ask you for information, submit it in a timely way. Not for me to ask you for information on Wednesday or on Monday today, and then you give it to me on Friday. You get it. It is two-way. There should be a lot of cooperation. Maybe I need to also advise on something you said. You never put conditions on payment when you're paying an auditor. It is not right. It's not professional. Like you can't say, if you don't give me the report in 30 days, I won't pay you. That is not right. It will affect the whole process. Yeah. And like I said, you can do that with a small audit firm. They will bend low, right? But for a big audit firm, the moment you tell them that, they will decline your assignment, because you are going to affect their independence. And to them, the reputation is very, very key compared to money, because they're a brand. PwC is a brand. If they just play to your tunes because of money, then they're likely to be intimidated. Yeah. So the timing is agreed upon, but an auditor cannot accept time that is not sufficient for them. Yeah.
Thank you very much, sir. Thank you very much.
You're welcome.
Sir, I think partly that is what led to the collapse of Enron.
Yes, yes.
Because several people had different interests and they were money-minded. So
Yeah,
I don't think that influence would work on the audit firm.
yeah. Yeah, you're right. But again, on his side, where especially where the business is owner managed, like the owner is the CEO and he thinks, these guys are probably stealing from me. Yeah, then he gets some briefcase audit firm, what we call briefcase audit firms. These guys who don't have a permanent address, they are really, really dying for work. You get. They will say, okay, yeah, I will do the work, I'll do it the way you want. It's not a lot, because they want to close the business. Yeah. They won't do a good job. I'll tell you for a fact. We've seen situations back in the days when I was still auditing. We've seen these situations where someone will call you, will call back, will now recruit the audit firm that I was working for. It was called Sejaka and Kawase, CPA. Then they say, we had an auditor who looked at this thing, but we're not comfortable. We would want you to relook at what they did. And when you look at what they did, really, it was not really to standard. But those people were maybe put in a corner, and they had to do what to do. They had to do what they had to do, but it is not right. Even when you become accountants, when you become auditors, even if you set up your own audit firm, please don't do anything that is going to compromise your professionalism. Because at the end of the day, when something goes wrong, it is you who is going to suffer as a practicing accountant, not the client. The client will fire you, but your brand, your reputation, and your career will be tainted. Yeah.
Thank you, sir, for mentioning the briefcase pharmacy. Could that be the reason why companies are employing auditors?
Yes. Yes. Someone will bring in, some people, some people have not really appreciated the role of auditing. They will only call on auditors when they want to find out fraud. You get, and for me, that is reactive in nature. It's reactive. It's not good to be reactive. It's better to be proactive, like set up good internal controls, and you can once in a while bring in an internal auditor, someone who would come in, like, wants to check whether things are okay. Then by the time the external auditor comes in, at least, he's not, it's very bad for someone to just issue a report, oh, things are not good, they stole your money, but at least if you have controls that will at least detect and show you that, by the way, these guys are probably stealing from you. Probably. Like someone who will show you, but these bank reconciliations have not been done for 2 months. It is better for you to fight a fraud for 2 months than fighting a fraud for 12 months. Yeah, so it's I suggest that even where you're working, please advise your bosses or in your businesses once in a while, get an auditor to look at what things that are being done, and also invest in internal controls. Yeah. Someone is asking, Zam, what does it require for me to become an auditor? Zam, you can become an auditor, get good grades. You'll be taken up by an audit firm. Then you can actually start practicing auditing even before you do CPA. You get it. So what happens is that they take you up, then they train you. They will actually pay for your CPA as you're doing work for them. Then when you do CPA, of course, you now become a professional accountant. You are experienced enough. Yeah. So all you have to, for example, to be a good auditor, you must appreciate IFRSs, International Financial Reporting Standards, International Accounting Standards, because you can't audit something you don't know. You get. So it is better like that. So you do your CPA, you do your SSCA, get some experience, but you start with getting good grades here and loving accounting and auditing. Josephine, thanks for the compliment. Okay, yeah.
Thank you, sir. So there is where you mentioned of under audit planning, where you have to look at if say you have been given an opportunity to audit, and you mentioned of hiring others.
Yeah.
Where, because I look at you have been you are an experienced auditor, and we expect the best from you. Why do you again go and hire? Is it because the manpower is not enough, or is it because you feel incompetent to take up certain projects to audit?
Incompetent is a very strong word. Eh? You may not have the expertise. Eh? For example, I'll give you a situation. You know, like oil and gas. Eh? You know, oil and gas is a complex area. Really, if you look at auditors, a few, I think it's only the big four that have the capacity and the ability to audit oil and gas. So just imagine you've been appointed, maybe by Starbucks, and they say, we would want you to become an auditor. It is very important in life, guys, to accept when you don't know something or when you're not good at something, and to seek assistance. So that is why in accounting, we have that professional due care, you know, like you must do your job. You must look at performing your job diligently on top of anything else. So where you feel that you are short in terms of skills and expertise, then you bring in an expert. You bring in another person to help you. For example, you might be auditing a construction company, or you might be auditing, let's say, you're auditing, let's say, government project. And that government project, there's a construction that is being done, and you're supposed to audit that construction, right? And you are not an engineer. You cannot ascertain whether the stage of completion shown and which that was paid for is actually what was delivered. So in that way, you need to get the help of an engineer to come and tell you, okay, at this level, I think it is 80%. Then person that will actually even give you a report. You might have to get an architect, you know, to give you a report to confirm that the stage of completion is actually 80%. You get, so that then you're confident that what you're going to issue in your report is the correct thing. So it is not that you don't have the capacity. Yeah, it is only that you need other people really to help you.
Thank you so much, sir.
Okay. Okay, so now I think now we can look at risk assessment. Yeah, what is done under risk assessment? And it stems from what we call audit risk. Yeah, now, like I said, it is very, very important that as an auditor, you identify the likelihood that material misstatements may actually occur within an entity. But that stems from you understanding the entity very well and its environment, what they do. Yeah. Then you look at their processes. Then you identify any possibility of material misstatements due to either error that is unintentional or fraud that is intentional. Are we together? But before you are in a position to ascertain ascertain the risk exposures, you must clearly understand the entity. You must be well conversant with what they do, the nature of business they do. That is when you understand the activities that they are involved in. For example, you know that in a bank, it is very easy money to be stolen. there's a lot of exchanging hands. Money can be easily stolen. So in that way, you have understood the nature of business that these guys are in. That is the first step of doing a risk assessment. So what makes up audit risk? First of all, audit risk is the possibility. Oh, sorry about that. I'm really sorry. The challenges of working from home. Yeah, audit risk is a risk that an auditor might express or might come up with an inappropriate audit opinion on the financial statements. For example, the auditor might say the financial statements are free from any material misstatements. Are we together? When you say that, you are giving the reader of the accounting information confidence that the activities of the business are taken in a good way. And that reader, the user of your accounting information, will place reliance on what you're telling them, and they will make decisions based on what you're saying. So, as an auditor, it is always important that you gather enough audit evidence that will help you come up with an appropriate audit opinion. Yeah. So where we say that there's audit risk, that is the likelihood that an auditor will issue a wrong opinion. Okay. Then business risk is coming from the conditions and events that surround the entity's operations. And when we talk about business risk, we are looking at inherent risk and control risk. So when someone tells you audit risk is a combination of inherent risk, control risk, and detection risk. But inherent risk and control risk are called business risks. Yeah, detection risk is the component of audit risk, but both combined, they will affect all the three will affect your audit opinion. So inherent risk is the vulnerability of financial statements due to the nature of the entity, the culture, the environment, the operations of the business, the characteristic of the account balance you're looking at. For example, cash at bank and cash at hand are more vulnerable to theft because cash is portable. It is easy for someone to steal cash compared to someone stealing a computer. Yeah. So the inherent risk arises from the characteristics of an entity. A manufacturing firm may not be as risky as a bank. Moves as a financial institution may not be as risky as a bank. So different businesses have different levels of inherent risk. So when you are determining inherent risk, you look at like what industry is the business operating in. Financial institutions are more vulnerable to theft because they deal with monetary, issues. The nature of the business, for example, yeah, I don't know if anyone remembers a company called Yotoda. Yotoda used to be Yotoda was a transport company that used to collect a lot of cash. Every minute, Yotoda used to collect cash. There were very many people who were collecting cash on behalf of Yotoda. So the cash was in the hands of many people. That was a very, very big inherent risk because as people were retiring for the day's work, they would take the money. And there was no control like the money you collect, you bank it before you go home. No. So the nature of the business poses the inherent risk. The characteristics of the account balances, like I said, cash at bank is more risky compared to a non-current asset like furniture and fittings. I don't know. I think there's a debate here. Okay. So we have now control risk. Control risk is the risk that a misstatement, a material misstatement, can occur due to the weaknesses in the internal Hello.
Hello.
Yeah, I'm so sorry. Something wrong happened to my connection. Yeah. So we can start. We can continue. We're talking about control risk, and like I said, it is as a result of weaknesses in the internal control systems, in the way that they cannot prevent, neither detect or even correct any material misstatements. Okay. And normally these are it's created from things like having when you have good segregation of duties, then your control risk is low. And when you have physical controls like keeping money in a safe, segregation of duties is having different people do different tasks. Physical controls having money in the safe, like limiting access to valuable assets or valuable items. Processing information or automatically or automated information processing, and where you have audit trails when you present something, but then it can easily be tracked, by someone, So those will help you have
So
the right.
would you recap the factors?
Yeah, I'm saying the factors, like a manual information processing system has more weaknesses compared to an automated information processing system. Because for an automated one, there's an audit trail. Who did what? When did they do it? There it has more controls. But it also has its own weaknesses though, because with technology, there's also a lot of exposures. Then physical controls like maybe keeping money in a safe, limiting access to where there's valuable things like contracts, cash, checklists, keeping your inventory, in a closed environment, segregation of duties where you have different people do different tasks. That limits your exposure to control risk. Where you have where you keep changing. For example, this 1 year, this person is an accounts payable. Then the other year, you probably make them accounts receivable or to be to be a cashier. Doing reviews, performance reviews. For example, when the bank reconciliation is done, how often do you review and who reviews? It is normally recommended that a bank reconciliation is reviewed like after 15 days after its performance. Like if it is a bank reconciliation for January, it should be performed and reviewed by 15th of February. Yeah, so those are the factors, sir. I don't know whether it's clear.
Very clear, thank you.
Okay. So we've looked at inherent risk, then control risk, then detection risk. Detection risk is the risk that the auditor, despite performing those procedures, the substantive procedures, the auditor is not in a position to detect material misstatements. One, it may be because the auditor used an inappropriate audit procedure. For example, you want to confirm existence of a motor vehicle owned by the company, but then you only do vouching. Yeah, you want to confirm the value of the stock held by a supermarket or held by a particular company, and you don't attend a stock take. So you selected an inappropriate audit procedure. That audit procedure that you selected cannot help you detect a material misstatement in the financial statements. That is one. Two, you have the right audit procedure, but you misapply it. You apply a procedure meant for trade receivables, you apply it on trade creditors, or you apply it on cash. Or the procedure, yes, is on account receivables, but it is not sufficient for a particular audit evidence that you want to do what? To take. Okay. Then misinterpreting results. You might use the right or appropriate audit procedure, but you misinterpret the findings from your audit procedure. You don't have the capacity. It's the same thing I think I was telling MMM, that you might not have the capacity to interpret findings of a contract performed by a contractor because you're not an engineer. Yeah. So yes, the procedure that was done to ascertain the stage of completion is right, but you interpreting the results, the findings from that audit procedure, you do it the wrong way. So you may find that from your interpretation, there is no material misstatement. But yet in reality, there is material misstatement. That means you have failed to detect it. So that is the detection risk. And again, like I'm confirming and I'm emphasizing that audit risk is a risk that you issue an inappropriate audit opinion. And it is as a result of inherent risk, the risk as a result of the control, or the risk as a result of the characteristics and the nature of the business that you're auditing, and control risk, the result is resulting from the inefficient internal control systems, and the detection risk, failure to detect material misstatements by the auditor. So those are the components of audit risk, ladies and gentlemen. Yeah? Any questions? Any questions, ladies and gentlemen?
Could you please repeat detection risk?
Yeah, detection risk.
I'm being.
Okay, let me first start with this one. Detection risk is the risk that the auditor applies procedures or audit procedures, but fails to detect a material misstatement. Yeah, and like you don't find out that there is an error that was committed or there is fraud that was committed, despite performing all your audit procedures. And I'm saying that it normally happens when the auditor uses a wrong audit procedure, or the auditor misapplies an appropriate audit procedure, or the auditor uses an appropriate audit procedure but fails to interpret the results. Meaning that you may say that the financial statements are free from material misstatements, yet in reality, money is being stolen, and big sums of money. But because for you, whatever you did as an auditor did not enable you to really detect that these guys are actually stealing from the entity. So the risk that you may not detect that, the material misstatement, is what we call detection risk. Have I answered your question, madam?
Yes, thank you.
Any other question? Okay. So we've talked a lot about risk. So we need to understand what are these potential sources of risk, because before you assess risk, you need to appreciate where is the risk? Where can I find the risk? One, when you're looking at the potential sources of risk, you first look at the nature of the entity. By looking at the nature of the entity, what business does the entity do? What products? Who are their key customers? Who are their suppliers? What type of contract or employment contracts do they have? For example, where the employment contracts of the senior managers is heavily driven by performance bonuses. Yes, that is an indication that these guys can easily cook books, because when we are given bonuses, the higher the profit, the higher the bonus. So as a COO, I may be tempted to cook books, because the more profits I post, the more bonuses that I do what? I earn. Okay? The products, some products are highly risky, some aren't. Where you find that your client is relying so much on a particular customer, like that customer contributes 70% of their revenue, that is a big risk. Reason being that this client of yours will do whatever it takes to keep this customer, even if it means a compromising quality, compromising good, giving kickbacks, So the business operations are a big source of risk under the nature of the business. Ownership, related parties. You know what related parties are? For example, if you have a multinational company, as in it's in Kenya, it's in TZ, it's in Rwanda. What those guys do, they take profits, for example, from Uganda by saying, okay, we have lent the related party or the parent company in Kenya has lent the company in Uganda, has given it a loan, and that loan they are going to be paying at 20%. So you find the transactions are not at arm's length. You get, so meaning that these guys are actually using this relationship to repatriate profits from Uganda without paying taxes, because interest as a cost of capital is tax-free. Okay. Then organizational structure, complex organizational structures can lead to wrong accounting for the subsidiaries. Yeah, where you have, I think you guys have done accounting 3, group accounting, those group structures. Yeah, investment activities. Where for example a company is there's a process of taking over a company, or there's a process of one company being sold to another. The company that is being sold may be forced to do what you call creative accounting to show that the company is performing well. It has a big net asset base, because the bigger the asset base, the higher the purchase price. I think you guys have done accounting 3, where you see that the net assets, the higher the net assets, the higher the consideration. Okay, so the company that is being sold may be forced to manipulate figures to create a higher purchase price. Financing activities, where someone is really struggling to pay off their debt, to the extent that the borrowers are even forced to recall the debt. This person has not been paying his debt installments for the past 3 years, rather past 3 months or 6 months. That is a sign of a weakness in liquidity. And that is a going concern issue that someone needs to be worried about. Because as a company is operating as a going concern, there are a lot of risks that are encountered in that company. Then external factors. These ones were, the first source is the nature of the entity. What does the business do, right? Then the external factors, like the nature of the industry. A declining industry has a lot of failures. For example, in Uganda, Mansul, this is Mansul, I believe, about creative accounting, had it's something that's being done with Century Bottling Company as they prepare for an imminent sale. I don't know. Muereza, I don't know whether they are doing it, but just know that there is creative accounting. In creative, let me give you an example of creative accounting. Someone may overvalue their land because they are doing a sale, and part of the assets that are being bought, that land is also part of it. So what they do is that they will even get a valuer, a certified valuer. They tell this valuer, you know what, we are going to give you money. This land is worth this land is worth 6 billion, but we want you to say it is worth 15 billion in your report. So the guy will do that, will accept. Now this company that is going to buy that company that Mansul is talking about will come and say, okay, now we are buying land that is worth 15 billion, yet in reality it is worth 6 billion. However, what these people do, they do what we call due diligence. Yeah? They do what we call due diligence. And when you do due diligence, you get an external person. Someone is in twice, eh? You need to, we are getting feedback. So these people, in a nutshell, they do due diligence to confirm what you're telling them. But it is really, really rampant. People cheat others a lot. Nekesa Evelyn. Nekesa, please mute your mic. Okay. So external factors. External factors, the nature of the industry, like I said, for example, in Uganda here, the economic situation that we are in poses a lot of risk. Business failures, I believe you are aware that now businesses are failing. Yeah. Technological issues. Like I said, highly technological companies have a lot of exposure. For example, you know the issues with mobile money. A lot of people are losing their money because you know these guys are playing with systems. So the nature of the industry, for example, in the insurance industry, there's a lot of risk of understating reserves. Yeah. The regulatory environment, increase in tax rates may force people to manipulate accounting figures so that they create a lower chargeable income. Yeah. Where you find that a client has not been complying with the laws and regulations, that client, you're better off leaving them because it means they are completely wrong people. The financial reporting framework, where you have options or choices to make in application of an accounting standard, then there's a lot of exposure because people will try to manipulate application of these accounting standards. Okay, so the first one is the nature of the business, then the external factors like nature of the industry, regulatory environment, and the financial reporting framework. Okay, then the entity's objectives and the strategies. These are, for example, a business that is into rapid expansion has a risk of their controls not being sufficient enough. For example, as the business is over expanding, the more risks it is exposed to. So the more inefficient the internal control becomes, right? When a business introduces new products, the chances of these products not performing to the expectation of the clients are very high. And this leads to liabilities of warranties and guarantees. I don't know whether you've seen, I don't think it works here because here most of us drive second-hand cars. But in Europe, where someone buys a car, let's say from Mercedes-Benz, and it has some defects, this person is going to call for huge compensations from Mercedes-Benz on top of returning that motor vehicle. Yeah. So here, for example, in Uganda, there are very few businesses that would have such issues. Yeah. Use of a new IT system. A new IT system can cause very significant damage to a business because one, it may not be compatible with other systems. Two, it may take long to kick off. Three, the business may not, the people who are running the system may not themselves understand it properly. Three, because the IT people are the ones who may probably understand it, there is a very high possibility that they will commit fraud in that system because other people have not really gotten very much accustomed to the system. So the entity's objectives and strategies are also a source of risk. The more ambitious management of the business are, the more vulnerable the business is to risk. For example, a young management team will take a lot of risk compared to an old management team, because young managers are very, very ambitious. They're hungry for success compared to old managers. Because if a manager is 60 years, they have seen it all. You know, they have nothing to prove compared to these guys, you know, these flamboyant managers, 35 years, 40, you know, you want to show off every time that you're a performing manager. But these guys have seen it all, and they don't take, they take calculated risks. They worry about their reputation. So the entity's objectives and strategies are a source of risk. The accounting policies. The selections and application of accounting policies can lead to inconsistencies. There are some people who will only apply an accounting policy when it favors them. If an accounting policy increases profitability, they will apply it. If it reduces profitability, they will not apply it. So they will only comply when it benefits them, and they will not comply when it doesn't benefit them. So the application of accounting policies is a source of risk. I believe you know that accounting policies are organization-centered, whereas accounting principles are universal. Accounting policies are specific to a particular entity, and it is management of a company that decides on the accounting policies they want to apply. Now, the issue comes in on applicability and consistency in applicability. Some people will choose to only apply these accounting policies when they favor them. When they don't favor them, then they change them. So you'll find in many companies, they keep changing accounting policies every year. Today, if it favors them, they will take it like that. If it doesn't favor them, they will change it. Okay? Yeah, so those are also a source of what? A source of risk. Then, financial performance measures. Like I said, employee performance measures, where employees, especially management of a business, is given bonuses, performance incentives based on profitability. Trust me, those guys are going to cook figures. They are going to create sales that are not there. They are going to understate their expenses and overstate their revenues, because at the end of the day, they know a healthy bottom line means a healthy bank account to them. So it is not advisable to have the incentives, full incentives of management completely based on the PBT. Yeah, but majority of the incentives or performance measures to know that all the managers performed are based on budgets. Have you met your budget? Yes, because if you tell me if I don't meet my budget, you're going to fire me, I will find all means of meeting the budget. So in my position as a chief operations officer, I have a finance background. So if you tell me that if you don't meet this budget, I'm firing you, you are pushing me to pull out the 10 years experience I have of accounting and auditing, and I apply it there. What does it mean? I will cook figures because I don't want to lose a job. Yeah. So it is not always advisable to only gauge the performance of a manager based on them meeting the budget. Because I mean, I might have some good indicators that are not financial related. Probably I have grown the brand of the business. The business is more known compared to how it was previously. That is a performance. But if you tag my performance on financial terms, trust me, very many people will ensure that they show you they are performing, yet in reality they are stealing. Okay? Then the biggest source of risk is the internal controls. the internal controls. Poor internal controls are the result of failures of companies that you hear. Companies like the Enrons, the internal controls were not working. So when they were not working, they realized that they would also bribe the auditor. They brought the auditor. The auditor did not decided to keep quiet, you know. So the control environment, the governance, how strong is the board of directors? Are these directors so familiar with management, or are the management team the same people who appoint these directors? The risk assessment, the information systems, the control environment, monitoring these controls. There's a difference between having a control and it actually working. So many people have controls, but these controls are just on paper. They're not working, they're not effective at all. So this does not save the business. Actually, it is dangerous for someone to have a control and thinking it is working, yet in reality it is not working. You're better off not having a control so that you know that I have a weakness. Yeah. But you having a control and not knowing that it is not working is a very dangerous occurrence, because you'll be there comfortable, or everything is working, yet in reality, the thing is useless. Yeah. So ladies and gentlemen, when they ask you about the 6 potential sources of risk that you have to be very mindful of when you're doing a risk assessment, is 1, the nature of the entity, the external factors of the entity or the external environment of the entity, the entity's objective and strategies. They may be so ambitious to the way that they may force them into doing wrong things. The accounting policies, that is the application. These accounting policies, how do they apply? Is it in a consistent way? The financial performance measures, these the performance incentives of especially the managers, then tagging performance to budgets and forecasts, then the internal control systems. So ladies and gentlemen, we shall stop here for today. Let me entertain some questions before we close off.
Excuse me, sir.
Yes, sir.
Yeah, I was requesting to repeat for me the first point. The first point, my network was not okay. I came in when you had started the second one.
The first point of the sources of risk. This one here. Hello.
Yes, the first point of the sources.
Oh, that is the nature of the business. Eh? Yeah. So what I'm saying is that the nature of the business, the nature of the business is directly linked to the risk the business is exposed to. There are some businesses that are very complex, and there are others that are not really complex. For example, when you're looking at a manufacturing firm, it is not as complex and vulnerable as a financial institution, for example, a bank. Yeah. So the bank is more exposed to risk because the product, the services that they are in, which is money, is so vulnerable to theft compared to a manufacturing firm. Let's say a company like Royal Mattresses, because by the time someone is going to steal a mattress, they have really done a lot. Yeah. So when you're looking at the entity, the nature of the entity business, you look at the business operations. What products does it deal in? What are its key customers? Where a company is so reliant on a customer, one customer who offers like 70% of their revenue. That is risky. The employment contracts. A company that has multiple branches or outlets is so risky, because then it means that whatever the stock and the money is in hands of very many people. Yeah. So that nature of business based on the operation will show you the risk. The ownership. For example, where a business is owner managed, it is highly exposed to risk. The organization structure. Is this business a multinational? Where do they report? How many senior managers do they have? You know, where does this chief finance officer report? Where does the internal auditor report? You know, do they report here? Do they report to Nairobi? You know, investment activities, like if a company is in a process of being taken over, the owners of the business are selling it, they will be forced to overstate the value of that business, because then it means they will get more money from the sale. Then financing activities. For example, if you find that this your client has been defaulting on their installments to the extent that the borrowers are even considering recalling the debt or attaching property. Let me use an obvious example. If you're auditing Simba group of companies, the one of Bitature, yeah, there is a lot of risk. It's going concern. We all know that that company is now in a turmoil. We know that that company has liquidity issues because it has not been paying a debt for a long period of time. We know that this company is denying its involvement. It is denying taking someone's money. It is about to run bankrupt. It is actually in court due to failure of paying a loan. So when you're auditing this company, there is a lot of risk around its operations. So, sir, I don't know whether I've answered your question, Sebo. What's your question?
So my concern was where you said it's under controls, yeah, where you say that it's better you dwell with a control and know that it's not in operation or it's not active. However, I'm looking at a situation where say you have internal auditors, right? To what extent do those internal auditors would help mitigate such risks? Because the controls are there and they are in charge at that level. Yes.
Yeah. Actually, what is your name? When you say I don't like calling you
My name is Mwonge Moses.
Moses. Now, Moses, maybe let me first clarify. Of course, it is always good for you to have an effective internal control system, right?
So everybody
it is always right for you to have an effective internal control system. Keno, can you please mute your mic? I don't know who this person is. Keno, mute your mic. So Moses, I was saying that it's important to have an internal control system, but you have to keep on reviewing its effectiveness, right? Because, like, if for example you think that your controls are working well, you might be reluctant to do certain things. Okay, what that means is that you might be comfortable that, oh, my controls are functioning, yet in reality they are not functioning. So a person who knows that I have a weakness here would be more careful compared to someone who thinks things are okay, yet in reality they are not okay. I'll give you an example. If you have a dog at home and you'll be comfortable that everything is okay because it will give you security. But if you don't check whether your dog is actually active, people will reach, they will kill you because you think the dog is functioning well. The dog is okay. Now, to the point of the internal auditor you're talking about, it is not the job of the internal auditor to check. It is not the job of the internal auditor to make sure that the internal controls are working well. No, it is the job of management. The role of the internal auditor is to review the internal controls to confirm that they are actually working effectively and to recommend to management any improvement that has to be taken. So if the internal control is not working well, the auditor will detect and ascertain that it's not working and advise management. So someone who has an internal auditor is better placed compared to someone who doesn't have, because then you have someone who is going to be monitoring these internal controls to confirm whether they are actually working well. Is that okay, Moses?
You are the best.
Okay, thank you. Okay, someone, now this is about career. Uncle, now uncle, how can I tell? To the aspiring auditors, start looking for information about audit firms that can take you on as a graduate trainee. Yeah, more so if you are interested in the big 4 audit firms and understand the requirements, and at the right time, when they call for applications, you can apply, because the easiest way you can grow your auditing career. Yes. Thank you, Uncle. That is very good. And to add on to that, if you want to build a career in accounting, auditing, any other career, anywhere else, don't think about money when you're still young in your career. Think about getting more, learning more, building yourself. For example, when you start getting the little money you get, advance your career, go do CPA, go do SCCA, you know. But for the start, look at entering into an audit firm or in a company to learn how things are done. To learn some of these things we teach you, you guys have not seen them practically. Some of you actually read to pass exams, right? So it's very important that you get to see these things, to look at what does an invoice look like? How does an LPO look like? How is a bank reconciliation performed in practice? Leave these things of ticking here, and then you forge the thing to balance. No. How do I prepare accounts? How do I use an accounting software? You know, all this will be done. But the challenge with you people, when you start working, you want to get 2 million shillings, even when you know nothing. Yeah, you want to drive a big car. You want to live in an apartment in Naria. Are you getting me? It is better you first learn, grow your career, money will follow you. You reach a point when you don't do interviews. You know, you pass that level, you've built a name for yourself. You're on demand. Okay? Yeah. Okay? Yeah. So guys, that is what I have to tell you. In case of anything, in case you need any career advice, you need to ask any question, I'm going to leave my number.
Thank you so much for watching. Make sure you subscribe to the channel.